SoFi stock has done really well in the past year, and they are popping off again today off of some news that will help them earn even more. So nearly 8 million US student loan borrowers to see interest charges again starting very soon, actually on August 1st. According to the educational department, this is going to actually help SoFi earn more. And this program had a lot to do with the Biden administration's debt relief initiatives. So conservatives were very against this. Now it's basically coming back to the borrowers, the students who are going to have to start making interest payments again. So the reason this actually benefits SoFi is because, according to Bloomberg, this signature tax legislation is poised to benefit companies offering private student loans. SoFi Technologies is one of those main companies. So this could also, as you can see in this paragraph right here, refinancing demand should also accelerate with the resumption of debt collection and higher payments. And SoFi has terrific market share in student lending, and with a number of lenders pulling back in recent years, they expect the firm to be a primary beneficiary of increasing demand. So all of this benefits SoFi. Since this news came out, SoFi is up 3.71% today. In the past 5 days, they are up almost 15%, as you can see, making a nice jump, multiple nice jumps throughout the week. Over the past year to date, 36% or so, easily beating the S&P 500. Over the past year, SoFi Technologies is up 219%, and they don't seem to have a full 5 years yet being a publicly traded company, but they are up about 101.44% since they became a publicly traded company in a little less than 5 years. So they're actually a financial technology company that offers a wide range of services, including banking, lending, investing, and financial planning. And again, a huge player in the personal loans, mortgages, credit cards, and more. So their PE ratio is pretty high. A lot of people want like a 20 range or less for a PE ratio when they want to invest or when they recommend investing in something. But the thing is, you have to consider their returns. You have to consider what type of company they are. Some companies actually tend to be worth a high PE ratio. Now, they also do not have a dividend yield. Some people won't even buy stocks without dividends. But you also, again, have to consider what's your goal. Is your goal for growth? Is it maximizing your overall return? Or is it to just pay yourself like an allowance through dividends? So no dividends, high PE ratio, not usually a great combination that a lot of people would want a part of, but with their returns, let's look at some of their other numbers and see if this is worth buying. So year over year change as of the first quarter of 2025, you're looking at revenue and operating expenses up, net income down, net profit margin down, and earnings per share up significantly. As far as the balance sheet goes, you are pretty close between assets and liabilities, but again, this also can vary depending on the industry that the company is in. And their price to book is fairly low at 3.34. Now, if you look at what hedge funds are doing, the thing is they have not been super bullish on SoFi as of the last few quarters. In Q4 2024, they were all selling. And then in Q1 2025, mostly selling as well. We'll see if that changes or not with this news of the Trump administration restarting some of these student loan interest payments, and that supposedly helping SoFi make a lot more money. Now, if you look at insiders, it's a little bit of a different story. Over the last couple of months, insiders are buying more than they are selling. So you're getting mixed signals between insiders versus hedge funds. As far as analyst ratings go, they do have a 36.4% buy score, a hold score of 40.9%, and a sell score of 22.7%. So there's a lot going on there that's not entirely bullish, obviously. I usually like to see a much higher buy score from analysts than this. They do have a lot less ratings than a lot of more established publicly traded companies that might have double or triple the amount of ratings for analysts. But Still a little concerning that the highest rating is in their hold score, and their buy and sell scores are kind of neck and neck for second place. Now, they've done really well on beating estimates for earnings, and they do actually have their Q2 earnings call coming up very soon on July 29th, which is just a couple weeks away. Another indicator of whether or not a price for a company is fair can be the forward PEG ratio. Now, according to NASDAQ, forecast 12-month forward PEG ratio for SoFi is 3.49. Now, usually you want something closer to 1. It is a little bit high compared to many others I've been reviewing over the past couple of months, but not as crazy as some others. But like I said, I'd kind of like to see that a little bit lower. And you're also factoring in, they also have a high PE ratio, and you're not getting any sort of dividend yield. So you really need a lot of high growth to justify buying this stock. Now, I also like to see, well, how do their employees think the company is run? Do they think it is a well-ran company? 3.6 out of 5 stars is pretty good. It's not crazy good. It's not really as close to 4 stars as I'd like to see it, but I wouldn't say that's a deal breaker either. 65% would recommend working here to a friend, and again, it's above 50%. It's well above 50%, and I would say at least that's a fair majority of them having a positive experience working at this company and thinking it's pretty good. Anthony Noto, the CEO, some encouraging signs here. 82% approval rating for the CEO is a good sign. Now, another thing I like to look at, not only do I like to look at, the returns year to date, in the past year, past 5 years, past 3 years, as just kind of different levels of looking at how a stock is returning. Again, obviously, past performance does not equal future performance, but also looking at how they've done in the last quarter. Is the sentiment changing? They are up 92.87% in the last 3 months, or in the last quarter or so, and that is obviously a huge return. Now, many companies are up quite a bit in the last few months because they had the tariff news, especially the ones with China that really made the market dip, and then a lot of them came rising back up and to a market all-time high. So many companies are doing well in the past quarter or so, but SoFi has been outperforming many of them at almost a 93% return. Although this is great news for SoFi that they are going to have even more revenue coming in from interest payments soon, and probably a big part of why they had such a huge increase today on the 10th of July in their stock price. But I normally would give them a buy score based on all the indicators I've gone over. Some of them are a little bit close to the line for me. Some of them are obviously not ideal. But there are a few indicators like analyst scores, how expensive the stock seems to be compared to their earnings, and assets versus their liabilities, which is a little bit close in terms of their ratio there as well. I would say are kind of keeping me closer to the hold score right now. And depending on their next earnings call, that could change to a buy score very soon. But obviously, none of this is financial advice.